right, so what is the cash flow statement? So the income statement at the highest level is revenue minus costs equals profit. That's really all it is. The balance sheet is, if you think about your personal balance sheet, is how much money do you owe people and how much money do people owe you. You owing people is a liability, people owing you is an asset. It's like accounts receivable is people owing you, that's an asset. You on your payroll is accounts payable, that's you owing people, that's a liability. When you mesh those two together, you get the cash flow statement. So I talk about this quite a bit because I think it sort of grounds us in it. This is one example of an income statement: revenue, cost of sales, gross profit, operating expenses, total expenses, EBITDA adjustments, net income. Noel, can you spend EBITDA? Can you take EBITDA out of the bank? No. Can you spend profit? You can spend cash. I'm being a bit nitpicky here, only because the primary statement that we use all the time actually doesn't have a single dollar that we can spend. And I'm going to go back through that for Patrick. He's coming back. Nathaniel, thanks for joining us. Hopefully, if you have any questions, you'll pop in. Hey, Patrick.
You got to pop up. My computer was going to restart, and I was like, hopefully I'll get another pop-up letting me stop it, but it didn't. It just restarted.
So all I did is I went through an income statement from revenue through costs down to the bottom. So again, income statement is revenue minus cost equals profit. Your balance sheet is money people owe you. Those are your assets, or amounts that people owe you. Those are your assets. Amounts that you owe people, those are your liabilities. In the simplest form, that's what those two statements are. What I went through is on the income statement, which we spend so much time on: EBITDA, cost of goods, operating expenses. You get down to the bottom and you get to profit, even net income, but you can't spend net income. You can't go into the bank and take $10 of net income out. You can't go to the bank and go take $10 of EBITDA out. You can only spend cash. When you mesh the income statement with the balance sheet, the cash flow statement actually tells you how the cash is coming out of the business. And with the two statements, you can build the third. So let me hop into the cash flow. And then can somebody do me a favor? Maybe I'm going to put a timer for 7 minutes. After 7 minutes, I want to hop into a Google Doc to answer some of Patrick's questions. So please keep me honest here. I'm going to put a timer here. Okay. So cash flow statement. All right. So this is called the indirect method of creating a cash flow statement. Just if you want to look it up so you can get some knowledge on it. What you start with is your net income. So this is right off of the income statement. And then you adjust the net income for operating adjustments, which is primarily accounts receivable, accounts payable, and inventory. You adjust it for investment adjustments. You buy a building, you sold a truck, and then you adjust it for financing adjustments. You took on debt, you took on equity, you paid off debt, you paid distributions to equity. Raven, I feel like I may have lost you. A little bit.
Yeah, I mean, just some of the terminology I'm a little, I don't know it all yet, so.
It's fine. This is how you learn. I'm glad that you're here, at least spending the time. I was at Harvard Business School and I didn't know this stuff yet. So You got to learn. Non-cash adjustments. We talked about that. Nobody charges you depreciation. Nobody charges you amortization, right? So you add those back to net income to adjust it back to cash, right? Those are non-cash expenses, accounting constructs. Now, I'm not going to spend 20 minutes on these adjustments. What I'll say is that if I'm running ABC Widget Company, right, and I have a bunch of raw materials, I have a bunch of work in progress, halfway done widgets, and I have a bunch of finished goods inventory. If I sell finished goods inventory, which I could have taken to a bank or melted down and gotten value, if I sell that to Noel and Noel gives me an IOU, which is essentially what accounts receivable is, right? You sell to somebody and they pay you in 30 days or they pay you in 60 days. You gave up cash for an IOU. That now becomes an adjustment to understand cash. You had a cash or a cash equivalent in these goods that you gave away, and you took on a piece of paper and you're hoping that that piece of paper cashes out. And it does most times, but this is an adjustment based on accounts receivable. I don't want to go deep in this. Noel, I know you're probably going to hit me on email. We can talk about it, but let's just say that there's an adjustment for accounts receivable. Same thing for a payable. It's almost like if I have Raven come help me do some military stuff out in the woods outside of Georgia, and I say, hey, I'm going to pay you in 30 days. I took on something of value, and I'm giving him an IOU. So you have to adjust that to get back to cash. And I don't want to hop in too deep, but you should just know that as accounts receivable and accounts payable expand and shrink, it has an impact on cash. The easier thing to consider is on the balance sheet, accounts receivable, accounts payable, and inventory are typically considered inside of working capital. You do know if I have a finished widget and I get rid of it, I sell it, I lost value until that person pays me for it. So in that construct, it should be sort of easy to understand those are adjustments to cash. I'll move on.
Can I ask a question?
Sure.
So earlier you said the bank looks at the coverage ratio, they take the EBITDA over the cash outflows. So why wouldn't they use net income?
On some of their, so on fixed charge coverage ratio, which is a big one, they do use net income. But there's also, I think, an EBITDA over debt and some others that are EBITDA centric. So I may have misspoke in terms of all. I get in trouble that way sometimes. A lot of the bank covenants are EBITDA centric because they're going to limit how much debt you're going to put on there, and interest changes depending on how the business was operated.
Because your EBITDA is always more than your net income.
Yes. Yes. But you're going to pay your bank before you pay some other people oftentimes. The loans that you get from banks, if they start getting anxious, they'll start doing things that'll make you pay them. You'll owe Uncle Sam and pay your bank. And that's why they look at that way. Let's say I was McDonald's and I bought a bunch of buildings. I'd have to adjust my cash for that. If I was making John Deere mowers out in the heartland, I'd adjust for that, meaning I spent money to go get a building, a truck. I put a porch on the back of my office so my admin can hang out. Those are all, for here, they're zero, but if you spent money on those things, those would be adjustments too because you spent cash on those things. In addition, you have to adjust for debt. So you took on whatever, $1.2 million of debt, and each quarter you got to pay the bank $30,000. So that comes out of the cash flow statement too. And so when you net all of that, net income minus, these are called operating adjustments. You could call them working capital adjustments, essentially. When you net out your equipment purchases and CapEx, money you spend on investing in your business, and when you net out any debt you took on or equity you took on, that's how you go from net income to cash. And so now when this line says net increase or decrease in cash, I can go to the bank and get cash. I can't go to the bank and get EBITDA. So again, Noel, we talked about how specific do you want to be. I don't want to create a bunch of doubt in anybody's head by showing you this. I want you to know it's here. For 80% of the instances, you're just fine with the EBITDA calculation. If you get into a situation where you feel kind of over your head or something's not making sense, you may want to invest some time on trying to figure out how to do the cash flow statement.